G'day investors again, this is Peter. Now we're going to be talking about the indexes and the gold, the charts, and see how they're performing in the last week and what to look out for in the next few days. So first I put together this table showing the contracts we're looking at for which indexes and also the gold price, and also what margins are required with the this is dependent on the broking account you trade with. But these are the margins required. So for every contract you open, you need $33 for the ASX 200, 19 for the US market, and so on. So that also represents the profitability for each of the charts. So as you'll notice, the bigger the margin, the bigger the profitability typically happens. So you can see here the buy and sell strategy and what it's returned in the 5 months. Had we been trading that as an example? And these show the respective drawdowns required for each of those trades over that 5-month period. Now, the other thing to mention here is because the profitability varies, depending on which month or which days those profits were executed and which days they closed, the drawdown will also be impacted by a time frame in terms of when they, how much that drawdown was effective, depending on which time frame. We'll go through each of these individually. So the ASX 200 first of all. You can see here over the 5-month period, the 15-minute chart. It's been opened and closed a few times with a couple of drawdowns happening here with multiple contracts, and these are all single trades. Now we're up 48.64 at the moment had we started back here at the end of August. Just a reminder as well, as each of these 15-minute bars proceed into the new periods, the old 15-minute bars fall off. So this is a rolling 5-month chart as we progress. So in other words, the profits won't be showing accumulative over the coming weeks. Now what's happened also over the last couple of days, the stock market's taken a bit of a hit in Australia and also worldwide. You can see here it's fallen off from our initial opening back here. But that's okay, we're still in one position only. Again, we're trading 5 contracts for each of these. We opened it back here in a few days ago and it's fallen off, but let's see how it performs in the coming days. Next we'll look at the US market. Similar sort of story. This one's producing about $3,500 in profit for the 5-month period, with a couple of drawdowns and multiple contract openings here, and all the rest was single. So very similar to the Australian market. And this one here as well has dropped off similarly as the Australian market has. Next we'll look at the German DAX. So again, very similar. Couple of multiple contract openings here during the end of October period, but then it stabilized and single contract opens. And again, we caught out here a few days ago, or middle of early January. We had an opening of contracts there, but we're up about $9,900 there. We're up as high as 13,000. So we've dropped back a bit from our profitability, but let's not panic. Let's let the strategy work like it did back here. The FTSE 100 UK market, again we need $33 per margin there. Again, that's already accumulated a couple of contracts there. We're up to 15 contracts for the FTSE. Profitability has dropped off from around $6,000 down to just over $1,000, $1,300. But again, let's let the strategy work and see how it produces and how it recovers. Next, we'll look at the China market. This one's obviously done a lot better because of the higher margin requirement. Remember, we need, for the China market, we need $250 per contract opening. So that's by default going to produce a lot more profit, but also the price chart has gone a lot higher than the US and the Australian market, for example. Here it's produced $9,300, mostly single trades, as you can see here, mostly single because it's kept going up and closing, up and closing, up and closing. Lastly, let's look at the gold price. That's produced, it's only a small contract requirement for $9 per contract, but we're still trading 5 contracts to keep our data examples consistent. So look at spot gold. So again, we accumulated quite a few back here. We had a few openings back here, but then it closed out. Nice little profit. And we're up about $1,100 at the moment, and we're still holding that position there. We opened it here back in late January, a few days ago, and we're still opening it up. So it's going a bit of a sideways motion, but again, let the strategy work. But in summary, as you can see here, we're doing about $30,000 had we traded 5 contracts for each of these over the 5-month period. It's not a bad result, with some drawdown requirements. So back to the drawdown requirements as I was talking about, using gold as an example. You can see here the maximum drawdown required was from there down to there. So that was the maximum drawdown for gold over that period. So you would want to hope that the drawdown was not happening at the same time for each of the stocks. So let's look at gold, for example. That happened between around the 9th of November. Got as low as that point there, so to end of November, start of December. So from the 9th to, so most of November, it was going in a bit of a drawdown. Let's look at the ASX as an example. How does that compare from the 9th of November to the end of November? So you can see there from the 9th to the end of November, there was no drawdown, so you weren't affected there. Although there was a drawdown back here, and a smaller drawdown here. So let's look at the US market in comparison to the Aussie and to the gold price. Very similar to the Aussie market, the US, there was a drawdown here during that period, end of September, and a drawdown here again during the end of October, but nothing in relation to the gold price. So our biggest impact would have been those 2 periods for the Aussie and the US market. Let's look at China. Slight drawdown again, end of September, but nothing there. So you would have had a small drawdown for all 3 Aussie, US and China markets. Nothing impacted there for China. And very quickly, let's look at Germany and the FTSE. So again, end of September, no real big impact. October, there was up until the end of October, there was an impact there, and that was similar to the US and Aussie market. And that's, so those 3 countries were, or those 3 stock markets were impacted in that period. So I suppose what I'm saying is those drawdowns are not consistent across all indexes. They may vary in terms of when they were impacted. So for example, Aussie, US and FTSE and probably the German markets were impacted very similarly in the same time frame. So you need to make sure you've got the funds available for those drawdowns during those periods. All right, guys, that's it for today, and we'll review again the indexes and gold again this time next week. Thanks for watching, and click to subscribe and like the button if you like the videos. Thanks, and see you next week.